Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn and Associates with your financial market update for this Wednesday, the 27th of September, 2017, about 3:50 p.m. Central Daylight Time. So in between the time I put out my metals update and now, we've seen the president come on TV and outline his plan for the tax reform. The one thing it's not is revenue neutral. That means it's going to be fought. Doesn't mean it won't pass. It's interesting. I'm not going to go through it here. I've already written an awful lot for it for my subscribers in my newsletter and those that are my students in my course. So they'll get my take from it there. But from the time the plan came out, the market has slipped back a bit on all the markets. That doesn't mean they're not still up. They are. You've also kept the dollar firm as the other currencies have all stayed fairly weak on this news. Now we get into the battleground, and the idea here is to get this passed before year end. We'll see if the president can come up with a winner. He hasn't yet so far. Who knows if this will do it either. But when we go to the charts, we can see that here you are at 22,298. I had the 22,299. And this shows about where the market's going to close, because remember, the market settlement prices are already in as of 3:15. So you're trading around it right now. You are in an up thrust. When we go to a daily area chart of closes, see that? I could have moved that over there, but to make a long story short, your highest close is 22,376, and you've backed off from that now because you're 22,298. This is how the current chart action looks. Now, let's go over right here and see we have an outside day down, then an inside day, and today's high of 22,326, here was yesterday's high, 22,324, takes that out with another outside day. So 2 days have gone by since the outside day down. That's the first important thing to me, at least. That having taken place, even if you go through it, you can no longer say it's a bear trap. Number two, now you have an outside day up. What don't you want to have? You don't want today's lows to be taken out tomorrow or the day after. As long as they're not, the market looks like it's going to try to add to what? Gains. Yet when I take a look at the swing line, it is still in a downtrend. You have lower highs and lower lows. To negate the downtrend, you have to take out 22,343. Keep that in the back of your mind as we go to this chart. On this chart, you're at the 18-day average of closes. Now, if we look at resistance, it comes in way up here now at 22,555, support 22,115, and of course the lower Bollinger Band. But what I just said is we shouldn't take out today's lows if the market's good. So if you take out 22,343, you negate this, if you will, short-term trend to the downside. The good news for the market is you kept the embedded reading right on through everything. You've got a nice embedded reading. Obviously, you don't want to lose it, but until you lose it, I think that rules the day, and I think the pros are buying, trying to drive the prices higher. When we come to the December emini index, this index was lost when the market last night was in the 2490s. I know because I was watching it. Then it comes up, gets up to 2509 and a quarter after the president speaks, and it's given back about 5 points or so from there. But now what's the pattern? In this market, unlike the Dow, the market took out the high of an outside day down. Second day after it. That qualifies as what I call a trap for the bears, and the market often, I wish I could use the word always, but it's not, because it doesn't happen that way. Often, because I don't have one of my key moving averages above it, makes a run towards the upper Bollinger Band. We'll see if that works out. The interesting thing is both the S&P and the Dow are suddenly giving you reasons to be a buyer. When we come over and we take a look at the Nasdaq, let's come here. This day, it's the one I want. The high was 59.54 to 58.42, an outside day down. The rule is you should not take out the high of an outside day down for 2 trading sessions. If you do, you create what's called, in that case, a bear trap, and the objective is to get prices back to the closest moving average, which in this case would be right at that 18-day average of closes. You want to tell me what happened? You took out the 59.54, 59.62.65 is the 18-day average. You went to 59.63. So it's hit its target. It's no longer in a downtrend. Momentum is confused. It's not up, it's not down. It's trying to turn to the upside. The Russell is where the power is. It's had the embedded reading that doesn't even back off. It's riding the upper Bollinger Band, and today it shoots over it. It likes, for the small caps, small businesses, it likes what the president said, and this market really ran to the upside, and unlike the others, it hasn't given up very much of the gain here, 1.5 points from the high. So you can see where the fever is in the market. It's also now ahead of itself because it's over the upper Bollinger Band. The VIX has been fighting battles, as we know it does, often at that 18-day average of closes. It's trendless. It's got a lower low, a higher high. But what's the important number on the chart? The momentum. And the stochastics have stayed embedded. And that often leads to prices making a run for the lower Bollinger Band in this case, because there's no key moving average. The 100 of the 18 aren't under the current price. When I go to TLT, what you had, past tense, you had a market that had gotten itself way down. Remember when interest rates were shooting up? The market began a correction, goes up on Monday, hits the 18-day average. Now, when it did that, you created a pattern of a higher high and a lower low. You are out of a trend. Momentum turned up. You can see there. Now the momentum has to correct itself because it's in an oversold condition. Instead, what happens today is it turns right back down into that oversold condition. It's under the 100-day average, right back to the Bollinger Band. Very difficult. But the market is saying that it still believes that higher interest rates are coming. In the bond market, the pattern is bearish. Lower highs, lower lows. We had one rally, and now with all of today's action that came in, the bonds just got hit. And as you can see, they're interpreting this news as bearish. Obviously, the tax plan is good for the economy from what the market action is. That'll give the Fed the cover to do what? Raise interest rates. And that was the reaction to the market today. That's my interpretation. It doesn't mean I'm right, but that's my interpretation of it. You're also down to key support areas, the 100-day average and the lower Bollinger Band. And both numbers they are now under what? They're under 20. What were they yesterday? One wasn't under 20, but the day before both were under 20. The day before and the day before. What does that mean to you? Remember what I teach. You can come out one day of the embedded reading, but if it goes back in it the next day, it's back in place. And often you have to make a big move to do it. I think bonds qualify in all those categories, and they did it. Big move, nearly 2 full points, 1 in 30 seconds. That's pretty darn big, near the lows of the day. So you're still embedded. That tells me rallies in this market are still being sold until that particular reading is lost. In the December 10-year notes, embedded reading, market down. All it did is rally back to the resistance. Now, we were talking yesterday, and notice how this number, the 100-day, has become so important. You went down to it right in this area here, and for 1, 2, 3, 4, 5, nearly 6 days, over a full week, you were hitting it. You hit it again today, and then you let go after the president's speech. So we're getting an idea here that these markets are saying, nah, if this gets passed, it's good. So what you look for is if you start seeing like the healthcare, it starts falling apart, this bill, you might get a reversal on those trends. But right now, higher interest rates are there. If you've got higher interest rates, it's awful hard to be short the dollar. And here's the dollar for the first time. If we go back to yesterday, here's the dollar closing at 92.78, which was under the upper Bollinger Band of 92.83. You're over it for the first time today. Both of the lines of the slow stochastic oscillator, the momentum indicator, are not over 80. You're just in an overbought condition in a profit-taking area for the pros. That doesn't mean it can't add gains. There's nothing bearish there. but the odds of staying over the upper Bollinger Band now are 4%, not 5%, because it's going to settle over it today. And I count each one of those days as 1%. You know what I'm going to say on the euro? It's the exact flip-flop. Now, well under the Bollinger Band today. Yesterday, the market closed at 118.53, which is under the lower Bollinger Band of 118.70. So you have 2 days in a row where you're under. You're not embedding. That gives me a 3% chance. All that those chances mean is that I'm going to see something in the next few days that gets to the right-hand side of the Bollinger Band. What's it all saying elsewhere? It's also saying downside momentum is very big but oversold. Aussie dollar, same thing. So the currency markets are giving up. How's that for the word? Against the U.S. dollar. That is not something we saw for many, many months in a row. The dollar could be coming into its own right now. And the Japanese yen, embedded reading, came down. It tried to rally all day long, to be honest with you, and finally it's given up on that. And I think the pros are just going to keep selling this currency, because if the dollar is going to get higher rates, why are you owning the yen other than North Korea if a situation shows up? In the crude oil market, you have the embedded reading. Until that gives ground, the odds favor that all the breaks in the market are going to be bought up and the market's going to try to work higher. It's also doing what I call riding the upper Bollinger Band. You hit it 3 days ago, you hit it yesterday, and you're hitting it again today, or trying to hit it again today. The high today is 52.34. You missed it by 15 points. But it's called riding it. You're right in that area, and you're not pulling away from it. In the November gasoline, you break down with the loss of the embedded reading. So let's go here. Here's the market fully embedded Tuesday. It lost the reading today, and where does it go? Right back to the 18-day average, if you will, and holds it. It's classic what I teach. Now the question is the market going to give up a trend or not? I don't know. Natural gas got a boost because of the hot weather. You know, I'm sitting here still fighting the hay fever, and I get all the comments from you on YouTube, and I see it. I am on all those pills. I've had hay fever since I'm a kid. I actually went to college in Arizona because I had to breathe, and I needed it real bad. The Midwest is terrible for pollen and mold. And you get older, you grow out of it, and then it comes back. It's the weirdest thing. But lower lows, higher high neutralizes itself by running back up to the 18-day average of closes. I say there's no trend in that particular market. Now, you see me talking about this, but you don't know necessarily how to do it yourself. I use 5 indicators. One you don't see here is this one, called window envelopes. And window envelopes are just what they say. You have a center line, and then you have resistance, points above the market, and below the market. The way I teach it to you is probably different than you've seen it anywhere else. I don't show it in the videos you're watching on YouTube. I show a lot of things separate than you see here in what? In my charting course, in my morning updates for my students and the subscribers of my research. My goal in the morning at 8:30, I record, and I'm trying to throw out trade ideas for you. If you want to learn them yourself, then we're really on the same page, because then as you're watching these videos, you know word for word what I'm talking about, and you see why I'm saying this is where I think the pros are buying, selling. Why don't you buy here, put a stop there? I'm able to do that in that video. I can't do that on this video because that's protected by user ID and password. It's also included in my charting course. That's a $60 a month value alone, the research. Then the charting software that you play with to do all this, that's a $100 a month value. You get a $160 value, and the course itself, 6 hours of videos, lots of written material in it. How much? What did I say? $109.95. It's a great deal. You're investing in yourself. Think about it. It's basically $1 full in the gold contract, 2 cents in the silver contract, 2 cents in the corn contract. There's no shipping fees, none of that nonsense. Everything is over the internet for you. Well, if you'd like to learn more about that, I want to teach you. You can either go to our website at www.iraepstein.com, go under the word education, everything's right there. You'll see it listed for you. You can always go to our website. That's one way. You can call my staff, 866-973-2077. They'll work with you. Take a credit card over the phone. You'll get going. You can click up here if you're watching YouTube, and that'll take you to the pages about the website. Or underneath us, it always says, click here for Ira's free offers on different websites. Why don't you take advantage of everything? I'm Ira Epstein, and I will talk to you all tomorrow.